Overtrading is one of the most common pitfalls in the trading world, yet paradoxically, it's also one of the least recognized. It's a behavior that, if left unchecked, can lead to financial ruin, even for the most experienced traders. But what exactly is overtrading? Why does it happen, and how can we prevent it? Overtrading occurs when a trader opens too many positions or trades excessively without a clear plan. It can manifest in two main forms: by volume, trading with positions that are too large relative to the account size, or by frequency, entering and exiting the market repeatedly. This behavior not only harms your financial results, but also takes a toll on your mental and emotional well-being. The causes of overtrading are often tied to psychological factors. One of the most common triggers is greed. Many traders feel they must capitalize on every small opportunity the market offers, not realizing that not all market conditions are ideal for trading. Another trigger is the fear of loss, leading some traders to re-enter the market constantly in an attempt to recover previous losses. And then there's overconfidence. When a trader experiences a winning streak, they may feel invincible and start making impulsive decisions. The impact of overtrading can be devastating. In the short term, it can result in significant losses because decisions are often driven by emotions rather than analysis. Over the long term, it can destroy a trading account, eroding not only financial capital, but also the trader's self-confidence. Additionally, overtrading leads to physical and mental exhaustion, further impairing the ability to make objective decisions. So, how can you avoid falling into this trap? The key lies in discipline and planning. Before trading, it's essential to have a well-defined trading plan that includes clear rules for when to enter and exit the market, how much risk you're willing to take per trade, and how many trades you can open daily or weekly. Another powerful tool is keeping a trading journal. This record allows you to analyze your behavior patterns and identify if you're trading more than necessary. Additionally, learn to accept that you can't capture every opportunity the market presents. Sometimes, the best decision you can make is to stay out of the market. Emotional management also plays a crucial role. Recognizing when you're trading based on emotions rather than logic is critical. If you feel like you're losing control, it's best to step away from the market, take a break, and return only when you're mentally ready. In conclusion, overtrading is a silent killer that may seem harmless at first, but can wreak havoc on your results if not addressed in time. Remember, in trading, less is more. The quality of your trades will always be more important than the quantity. Learn to be patient, disciplined, and respectful of your trading plan. Only then can you avoid overtrading and move closer to success in the financial markets.